Seth, good having you. Thanks much for joining in. We heard news about possible quarantines or a lockdown mode for California as well, so all the best for that. The question is, what does all of this fear do to markets? Is it too soon to call it a value buy, because this may become even more valuable?
Well, this is definitely a serious fear environment, as we discussed might have been the risk when we talked on last Tuesday. I think several deep value investors are looking at shale producers here in the United States that have just really taken a severe hit. But I think we're not done yet. We're looking at over a 4% decline, 4.25%, I guess, right about now, after the president tried to give a speech to reassure Americans and the world that things are under control.
Yeah, well, that doesn't certainly seem to be helping, Seth, right now. And that's my question to you, Seth. As somebody who's looked at markets all through these years, is it possible to predict where is it that flows might start coming in? I mean, yes, there is value right now, well established. Is there any indication of when flows could start coming in? I guess not.
I think it's a little too early if you're looking at what's going on in the market today in Asia and futures in the U.S. This news about blocking visitors from Europe was quite a surprise, I think, in terms of how broad that kind of statement is, carving out the U.K. And it looks like, the coronavirus could have, the problem here is that the effects of this are going to be lagging. It's not as though if the virus went away in 2 weeks, things are going to snap right back. And that's where the risks are, because ultimately it's about earnings. And this is extremely disruptive.
Right. Seth, good morning. I mean, Donald Trump did try to soften the blow a bit by saying that these restrictions are on people and not on goods. So, trade will not be affected in any fashion whatsoever. But that didn't seem to, soothe any frayed nerves, for the equity markets. What's your sense on whether or not it's going to be risk off for some time in terms of equity trades? There will be other avenues, there are different asset classes where money can be pushed into, but equities as an asset class will continue to see outflows for some time.
Well, it depends. The news, the words tonight are that maybe there's reached the capitulation, but I think there's actually still room for further decline. And this notion that this is about people and not trade is a misnomer. There's already talk about, within China itself, the extent of factories staying closed and so forth. There was even some news earlier today here in the U.S. about school supplies being in short demand for the fall. And it's, we're only in March. That indicates how far in advance importers are making their plans, and they're looking at shortages. This affects auto parts. This affects all kinds of industries. And it is about trade, because if people aren't going and traveling, they're not buying products. They're looking at losses. We're a 75% consumer economy, and people looking at their retirement funds and savings going down 22% in a very short time is very frightening.
In all of this, Seth, while the global equity markets are in a bit of a panic and frenzy, look at China, the epicenter of the problem where it all started. China has actually managed a V-shaped recovery. They've bounced back, and while they are still, in some amount of pressure in light of what's happening globally, they are way off the lows.
Well, China has been in a decline for the last few years, and there is a sense, I guess, that maybe the worst is over for China. But there's also a sense in the U.S. That with greater availability of coronavirus testing, that it's going to become more apparent that more Americans are actually infected with the virus. So I don't have much greater explanation about the China market other than the fact that we also can't necessarily rely on the information about the extent of the virus coming from China either.
Right. Seth, one last question. Most of the conversations that we've been having have suggested that emerging markets, for that matter, once the bottom is in place, will have a far superior outperformance versus developed markets. Is that a view that you hold?
Well, possibly for larger caps because of the greater ability for traders. It has to do more with structural issues and the float and the fact that many of these shares are in indices and index-based funds. So that may be true, but in a general risk-off environment and in a situation where there are competing markets that are pretty badly beaten, starting with the U.S., I think it will be slow to see money flowing back in large amounts, flowing back into emerging markets in the near term.